We all know about the stock market. We all know what stock market is, how do we invest in the stock market, who are the players, and how the stock market works. Probably we have little bit of idea, or maybe we are experts in that field. We'll see. But do we know there is another market that exists? That's the money market. So what is a money market? We'll see all about the money market in this video. Stay tuned. So these are the short-term financial assets with a liquidity of 1 year or less and are traded in the exchange. So these are termed as the money market. Who are the participants? They are the banks, large institutional investors, big HNI clients, mutual funds, and so on and so forth. Okay, so it's for the big players. So what are the objectives of a money market? Why does it have an existence in this country? So the reason or the purpose for this money market is to provide short-term funds to the investors at a reasonable price. It also enables lenders to turn idle investments into effective instruments, effective investments. Okay, and it also helps in regulating the level of liquidity in the country. So these are the main objectives of a money market. So what are the products that are traded in the money market? Let's see. Government issues treasury bills. So treasury bills it's the most popular product in the money market. The government issues this for a period of 2 weeks to approximately less than 1 year, and it comes at a price range of 25,000 and its multiples. Way and mean advances, WMA. So these are instruments that the government borrows from the RBI for a period of not more than 90 days. CMB, cash management bills. Again, it's the government's borrowing for approximately for less than 90 days. Okay, maybe a couple of months or maybe a month or so. That's where these kind of borrowings are termed under CMB, cash management bills. Certificate of deposits. So these are the term deposits accepted by commercial banks. They are issued through a promissory note for a period of 3 months to approximately 1 year, and it comes at a lot size or maybe a price size of 1 lakh and its multiples. So who issues it? The corporate banks like the State Bank of India, they would issue a CD, and large institutions would buy them. Corporates, large institutions, corporate bodies, HNI clients, they would buy them. Commercial bills. What are commercial bills? Commercial bills are short-term money that one company lends to another company for their immediate funding needs. So it's between one company to another company. When they lend money for immediate requirement, for short-term money requirements, that's where one company lends money in the form of commercial bills. So commercial bills is a short-term money requirement. Commercial papers, it's for a little longer requirement. If the company requires money for maybe 15 days to a year, that's where commercial paper comes into existence. One company will lend money to another company for a period of maybe 15 days to a year, and that's what they term as the commercial papers. Call money. It's not call put, it's call money. So what is call money? When a commercial bank lends or borrows between themselves, it's between two banks, not between corporates. So it's between two banks. When one bank lends money to another bank for a very short period of 1 day, it's called call money. Notice money, the same thing, one commercial bank lending to another commercial bank for a period of not more than 2 weeks. Okay, so that's notice money. What is term money? So term money again is a lending, or one commercial bank lends money to another commercial bank for a period of more than 14 days. What is a repurchase agreement? It's a short-term loan between the buyer and the seller for the purpose of repurchasing. Okay, these transactions are carried out by the government-approved securities like the treasury bills, the PSU government bonds, and so on and so forth, etc. What is banker's acceptance? Banker's acceptance is basically a promise from a commercial banker for a future payment. This is a promise and it's a guarantee from the commercial bank. So that's a banker's acceptance. These are some of the financial instruments in the money market. It's considered safe because it's between corporate houses, between the government, and the RBI is in place. Is monitoring all these things. So it's a very safe environment to work on, and so large institutional investors, they play on this market quite regularly. Now we saw borrowing from the government, we saw the government borrowing, we saw corporate houses borrowing, we saw the banks borrowing from other banks. What about borrowing from the RBI? How do we borrow from the RBI? What are the terms? What are the rates? Repo rate. I'm sure you must have heard about this. Yes, a repo rate is a rate when one bank approaches the RBI and takes a loan from the RBI. The rate of interest that the RBI charges from that bank is the repo rate. The loan tenure is approximately less than 90 days, I think, for 3 months. So the repo rate is the rate that the RBI charges the bank for the loan tenure of less than 3 months. Bank rate, it's again when the bank borrows from the RBI for a period which is more than 3 months. MSI, marginal standard facility. This is again when a bank borrows from the RBI for a period of 1 day, a very short-term loan. It's called MSI. So these are some of the instruments, and these are some of the terms that are used in the money market place. So we all knew about the stock market, we all know a little bit on the stock market. So I thought of sharing some information about the money market and who plays in the money market. Maybe sometime when you, me, and everyone who are involved with us, who are involved in this family, we all together will grow one day, and probably we will play in these money markets. Till then, SG signing off. Goodbye.